Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving deep into one of the most important and often misunderstood policies in global macroeconomics, Japan yield curve control. If you trade currencies, bonds, or even equities, this is not just a niche topic. Japan's yield curve control, often referred to as YCC, has had a major influence on global markets for years. And as conditions shift, it's becoming even more relevant. So, in this episode, I'm going to walk you through exactly what Japan yield curve control is, why it was introduced, how it works in practice, how it differs from quantitative easing, and most importantly, what it means for you as a trader or investor. Let's start with the basics. At its core, Japan yield curve control is a monetary policy where the Bank of Japan, or BOJ, directly targets interest rates across the government bond yield curve. Now, most central banks typically influence short-term interest rates. That's the standard approach. But Japan took things further. Under yield curve control, the BOJ sets a short-term policy rate, which has historically been around negative 0.1%. But more importantly, it also targets the yield on 10-year Japanese government bonds, usually aiming to keep it around 0%. And here's where it gets interesting. The BOJ doesn't just guide the market toward that level, it enforces it. If yields start to rise above the target range, the BOJ steps in and buys government bonds to push yields back down. If yields fall too low, it can scale back purchases. So instead of influencing markets indirectly, the BOJ is actively controlling outcomes. Now, to really understand why Japan adopted this policy, we need to step back and look at the broader economic context. Japan has been dealing with economic stagnation since the early 1990s. This period is often referred to as the lost decades. During this time, Japan experienced weak growth, persistent deflation or very low inflation, an aging population, and a massive buildup of government debt. Traditional monetary policy tools just didn't work as expected. Cutting interest rates to zero didn't generate enough demand. Quantitative easing, which involves large-scale bond buying, also failed to produce sustained inflation. So by 2016, the BOJ was in a difficult position. It had already bought a huge portion of the government bond market. The yield curve had flattened significantly, and this was creating problems for financial institutions like banks and insurance companies, which rely on a healthy spread between short-term and long-term rates. At the same time, inflation was still nowhere near the BOJ's 2% target. So the BOJ needed a more precise and effective tool. That's when Japan yield curve control was introduced. Now let's break down how this policy actually works in practice. First, the BOJ sets its targets. As we mentioned earlier, that includes a short-term interest rate and a long-term yield target, typically focused on the 10-year bond. It also defines a tolerance band, which allows yields to move within a certain range around that target. Second, the BOJ continuously monitors the bond market. This includes tracking yield movements, trading volumes, and overall market conditions. Third, when yields move outside the desired range, the BOJ intervenes. And it has several tools to do this. One of the most important is fixed rate purchase operations, where the BOJ offers to buy bonds at a specific price. It can also engage in unlimited bond buying if needed, which sends a strong signal to the market. And that brings us to a key point that's often overlooked. The power of Japan yield curve control is not just in the actual bond purchases. It's in the credibility of the policy. Markets believe that the BOJ will act decisively to defend its targets. And because of that belief, yields often stay within range without constant intervention. Now, you might be wondering why the BOJ focuses specifically on the 10-year yield. The reason is that the 10-year yield plays a critical role in the economy. It influences mortgage rates, corporate borrowing costs, long-term investment decisions, and even pension fund returns. By anchoring this part of the curve, the BOJ can have a much broader impact on economic activity. At this point, it's important to distinguish Japan yield curve control from quantitative easing because these two policies are often confused. Quantitative easing focuses on the quantity of bonds purchased. The central bank commits to buying a certain amount, and the market determines the resulting yields. Yield curve control, on the other hand, targets the yield itself. The BOJ doesn't commit to a fixed purchase amount. Instead, it buys as many bonds as necessary to maintain the target yield. So in simple terms, quantitative easing says, we will buy this much. Yield curve control says, we will enforce this interest rate. This shift gave the BOJ more direct control, but it also increased the stakes. Now let's talk about the benefits of Japan yield curve control. One of the biggest advantages is predictable borrowing costs. Businesses and households can plan with greater confidence when long-term interest rates are stable and low. This encourages investment, spending, and overall economic activity. Another key benefit is government debt sustainability. Japan has one of the highest debt-to-GDP ratios in the world. By keeping yields low, the BOJ helps ensure that the cost of servicing that debt remains manageable. There's also the issue of financial system stability. By maintaining a slightly steeper yield curve than would exist under deeply negative rates alone, YCC helps banks remain profitable, which is essential for a functioning financial system. And finally, yield curve control can be more efficient than quantitative easing. In theory, it allows the BOJ to achieve its goals with fewer bond purchases, although in practice this hasn't always been the case. But of course, no policy is without its downsides. One of the biggest criticisms of Japan yield curve control is market distortion. When a central bank is actively controlling yields, the bond market no longer reflects true supply and demand dynamics. This can lead to mispricing of risk and reduced market efficiency. Liquidity is another concern. Because the BOJ owns such a large share of Japanese government bonds, there are fewer bonds available for trading. This can make the market less liquid and more fragile. Then there's the issue of exit risk. Eventually, the BOJ will need to normalize policy. But allowing yields to rise could lead to sharp declines in bond prices, higher borrowing costs, and increased volatility across financial markets. Currency weakness is also a factor. Low yields tend to weaken the Japanese yen, as investors seek higher returns elsewhere. While a weaker yen can support exports, it also raises the cost of imports and can contribute to inflation. Now, over time, Japan yield curve control has evolved. The BOJ has made several adjustments, including widening the allowable range for yields and introducing more flexibility in how it conducts market operations. These changes reflect the growing challenges of maintaining strict control in a changing global environment. One of the biggest shifts in recent years has been the return of inflation. For a long time, Japan struggled to generate any meaningful inflation. But more recently, inflation has picked up. This creates a difficult balancing act for the BOJ. On one hand, it wants to maintain supportive financial conditions. On the other hand, it needs to avoid overheating the economy or triggering excessive currency weakness. So the future of Japan yield curve control remains uncertain. And this brings us to the global implications. Japan is not an isolated economy. Its policies have a significant impact on global markets. For one, Japanese investors are major players in international bond markets. When domestic yields are low, they invest abroad. If yield curve control is adjusted and domestic yields rise, capital could flow back into Japan, potentially pushing global yields higher. In currency markets, the yen is heavily influenced by interest rate differentials. Changes in YCC can lead to significant movements in currency pairs like US dollar to Japanese yen. Then there's the role of carry trades. Low Japanese interest rates have made the yen a popular funding currency. Investors borrow in yen and invest in higher-yielding assets elsewhere. But if YCC changes, these trades can unwind quickly, causing volatility across multiple asset classes. So what should you be watching as a trader? Keep an eye on BOJ policy announcements, especially any changes to yield targets or tolerance bands. Monitor inflation data in Japan. Watch the yen closely, particularly against the US dollar. And pay attention to any signs of increased bond market intervention. Even small adjustments in policy can have outsized effects. Before we wrap up, if you're serious about understanding macro trends like Japan yield curve control and using them in your trading, having the right tools and resources matters. You can explore a world-class, cutting-edge, user-friendly trading platform here at crystalballmarkets.com/platform. And if you want to build your knowledge further, especially if you're still developing your edge, I highly recommend checking out this beginner-friendly podcast covering trading, investing, macro, and financial markets. rss.com/podcast/crystalballmarkets. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next one where we continue breaking down the ideas that move markets.